Treating all digital yield as the same asset class is the fastest way to misprice your risk. There isn't one digital credit market. There are three structurally different animals, and if you evaluate them using the same framework, you are flying blind. In a market built on noise, this is structure. Digital credit explained. In the previous episode, we built the core vocabulary of digital credit, establishing yield versus return of capital, collateral, counterparty risk, LTV, rehypothecation, and on-chain verifiability. With that foundation in place, we can now take our first structured look at the three instrument families that constitute the digital credit ecosystem. This is an aerial view, the architecture before the engineering. Each family will receive dedicated granular treatment in Phase 2. Think of the three digital credit instrument families the way a fixed-income portfolio manager thinks about the broad categories of traditional credit: investment-grade corporate bonds, high-yield instruments, and structured credit products. Each has a distinct yield source, a distinct risk profile, a distinct evaluation methodology. You would not apply the same analytical framework to a AAA-rated sovereign bond as to a collateralized loan obligation, not because one is better than the other, but because they are structurally different animals. The same logic applies here. The first instrument family is Bitcoin-Collateralized lending. The structure is, at its core, a secured loan. A holder of Bitcoin who does not wish to sell their position, for tax reasons, for strategic reasons, or simply because they expect long-term appreciation, pledges that Bitcoin as collateral and receives a loan, typically denominated in US dollars or a stablecoin. The lender holds the Bitcoin collateral for the duration of the loan and earns interest on the loan principal. The borrower retains economic exposure to Bitcoin's price movements while accessing liquidity. The risk variables in this family are specific and identifiable. What is the LTV at origination? At what LTV does liquidation occur? Who holds the collateral, and how? Is the collateral rehypothecated, or does it sit in a segregated, verifiable custody arrangement? What jurisdiction governs the lending agreement, and what legal recourse does the lender have in the event of borrower default? These questions are answerable. The quality of the answers determines the risk. The second instrument family is stablecoin yield products. A stablecoin is a digital asset designed to maintain a stable value, most commonly pegged one-to-one with the US dollar. Holders of stablecoins can deploy them into yield-generating arrangements, lending protocols, liquidity provision strategies, and increasingly, instruments backed by real-world assets such as short-duration US Treasury instruments. The yield is the compensation for the risk of holding a particular stablecoin and deploying it into a particular strategy. The critical risk variables here differ substantially from those in Bitcoin-collateralized lending. What are the stablecoin's reserves composed of? Is the peg mechanically enforced or algorithmically maintained? What is the redemption mechanism? And has it been stress-tested? What smart contract or protocol risk exists in the yield strategy? And crucially, who is the counterparty, and what is their regulatory status? The third instrument family is the newest and the most structurally complex: fiat-preferred shares and Bitcoin Treasury credit instruments. These are structured equity and debt products issued by companies whose primary treasury asset is Bitcoin. An investor in these instruments is, in effect, taking a credit or equity position in a company whose balance sheet is anchored by Bitcoin holdings. The investment thesis is distinct from direct Bitcoin exposure. The investor is not simply holding Bitcoin. They are holding a structured claim, preferred equity, convertible debt, or hybrid instruments, on a company that holds Bitcoin, with all the corporate structure, governance, and financial engineering that implies. The risk variables in this family include: what is the company's Bitcoin per share metric? How much Bitcoin does each preferred unit represent, directly or indirectly? What is the premium or discount at which the instrument trades relative to its Bitcoin-adjusted net asset value. What is the subordination structure? Where does this instrument sit in the capital stack if the company faces financial distress? And what is the issuer's broader financial health beyond its Bitcoin Treasury position? 3 families, 3 distinct yield sources, 3 distinct risk architectures. The sophistication of digital credit analysis lies precisely in understanding that these families cannot be evaluated using a single framework, and that the failure to distinguish between them is one of the most common errors made by allocators approaching this asset class for the first time. The digital credit ecosystem is not a monolith. It is 3 structurally distinct instrument families, each generating yield through different mechanisms, each exposing the investor to different categories of risk. Bitcoin-Collateralized lending is a secured credit instrument. Stablecoin yield products are a blend of currency risk and protocol or counterparty risk. BTC Treasury credit instruments are structured corporate claims with a Bitcoin-anchored balance sheet. These distinctions are not academic. They determine which evaluation framework applies, and which risks a sophisticated allocator must price before a single basis point of yield enters the analysis. In the next episode, we examine Bitcoin's specific properties as financial collateral, and why those properties represent a genuine structural departure from every prior form of collateral used in credit markets. Clarity before yield, always. Digital Credit Explained.